watching the 80 Money Show with me, Kavita Thapliyal. Now, when it comes to insurance, it is not seen as an investment product. It is rather a mechanism for individuals to secure the future of their dependents in case of their unfortunate demise. But what if your insurance policy also doubled up as an investment product? Now, this is where guaranteed return insurance plans come in. This category of insurance policies provide a guaranteed return to the policyholder along with an insurance cover. But should you buy a guaranteed return insurance policy, and what are the things that you must keep in mind before buying such a policy? Let's bring on board Naval Goel, founder and CEO, policyx.com, to answer all of these questions. Naval, good evening. Welcome to the show. So as we always say, you need to keep your investment and insurance separate, and it's better not to have it clubbed. But then in insurance, we have these kind of products which also cover your insurance and investment part. Talking about guaranteed return plans, how can you explain this to us in the most simplest language? What kind of plans are we talking about?
Good evening, Kavita. So, as the name suggests, you already mentioned that these are basically guaranteed investment plans. So, let's say you do an FD. So you get a fixed return, but you don't get insurance coverage when you do FD, right? So what these plans offer is kind of a combination of insurance and the guarantee of your returns, which is usually in the range of 5 to 6% in the current market. So let's say you go for a 15-20 year investment plan. So what you get is you get a life cover for a certain sum assured, and you get guaranteed returns on your investments. The only thing that is that you should take care of is that the returns from these plans are basically better than FDs only because of tax benefits. So but obviously that is a limited benefit. You get tax benefit only on a certain amount, which is 1,50,000 currently in as per section 80C. So above that, it does not make sense to invest in these kind of plans.
All right, but then I also want to understand, talking about insurance investment part, now you are paying a premium for this particular product. How much of it goes into the insurance part? How much of it goes into the investment part? And what kind of investment instruments are we talking about? Two questions here.
Very small portion of your premium goes into insurance part, because the insurance coverage is very minimal. So usually in such plans, the insurance coverage is 10 times what you pay as annual premium, which is nothing as far as your actual insurance coverage requirement is considered, right? If you really want to cover yourself from an unfortunate event, you should buy a much larger cover. So a very small portion, that depends on the age that you are at, and obviously the other risk variations. So but the majority of the part goes into investing. So most of the insurance companies would invest this amount in either fixed income or equity, or they have a balanced portfolio. But having said that, most of this is protected by insurance company, in the sense that whatever better returns they generate, they can take from it, and whatever lower returns, they bear the risk. So at the end, policyholder only gets a fixed income from these plans.
Explain this to me with an example. What for how long can one buy these kind of policies? What kind of returns after a particular period one can get? If you could just explain through an example, what kind of features do we have in the policies which are available in the market currently?
Sure. So let's say you want to invest 1 lakh rupees a year. So you usually these plans start from 5 year horizon to 10 year, 15 year, 20 year. So let's say you go for a 10 year plan. So you'll end up paying 10 lakhs in 10 years, right? The insurance coverage is usually 10 lakhs, which is 10x of the annual premium. So if you get a 10 lakh cover for 10 years, which means that if something happens to the policyholder during this 10-year period, he gets the 10 lakh sum assured, which is the insurance coverage part. And if nothing happens, then at the end of 10 years, he gets the fixed benefit, which varies according to the age, but usually you can consider a 5 to 6% return, which means your money doubles in about 12 to 14 years. So if you are buying a 14-15 year plan, you can expect twice the money that you invested.
Money will be given to us as?
Which will be given to you as either a lump sum amount or
Okay.
benefit in terms of the monthly income. That is up to the policyholder to choose. Various plans are there, which kind of are designed to meet certain lump sum expenditure or monthly income expenditure. Depending on policyholders' choice, they can go for any types of payout options. So there are lots of plans in the market. Some plans offer only fixed benefits. Some plans offer monthly income. Some plans offer a mix of both. So you can basically, what you need to keep in mind is your life goals. Accordingly, you can design these plans.
Let's compare the insurance and investment part of guaranteed returns plans with term insurance and maybe an investment strategy that you must have had in your financial portfolio. The amount of coverage I get in a term plan, can I get that kind of a coverage for my life insurance as per these guaranteed return plans?
See, definitely not, because for the same amount of coverage, let's say if you buy a term plan today from market, usually for 15-20,000, you would be able to get 1 crore of term plan, right? But if you want to buy a 1 crore sum assured from a guaranteed return plan, you would have to invest about 10 lakh rupees in annual premium. So the difference is huge, 10 lakh versus 15 to 20,000. So what we usually suggest is to buy a term plan for insurance coverage, and the remaining amount you should invest in ULIPs, because ULIPs have lower charges, and the outcome of investing in ULIP is that you get better returns, because number one, the charges are lower, and number two, they invest in equities, and you can choose various options according to your risk profile. So equity, ULIP plus term plan is a better option than going for a guaranteed income plan.
All right, talking about the investment options specifically, are these also market linked investment products?
Yeah, ULIPs are basically unit linked insurance products. So you insurance coverage is there, but at the same time your money is invested. The charges are lower in the guaranteed plan, because the risk is being taken by insurance company. Usually, the charges are higher, and also the selling cost of traditional plans is much higher.
So, as per the calculation now, you told that one needs to really plan the kind of lifestyle and the kind of expenses one would have in the later stage when they would want a payout from this particular scheme. I'm talking about guaranteed return plans. So, what kind of back calculation one needs to do? There's a huge benefit of tax deduction, but then that you can get through ELSS also, and your term plan, your life insurance policy. So, the tax benefit is nullified. Low risk investment. Now, why do you say that?
So if you invest in ULIP, your returns are as per the market returns, right? So if, let's say, you go for a ULIP with a higher equity component, then it will depend on how the equity market does. Whereas a guaranteed plan gives you a fixed return. So you know what amount you are going to get, let's say 15-20 years from now. So that is the difference, because in ULIP you can get a much higher amount, but at the same time there is a risk of a lower amount as well.
All right. Now I want to understand the kind of tax benefits. While buying a plan, you can get any tax deduction, and once you redeem, once you get the payout, at that time, what would be the tax implication?
So these plans have tax benefit under 80C. So whatever you pay as premium up to a certain limit of 1.5 lakhs currently, so that is tax exempted. And at the time of payout also, the returns from these plans are basically tax exempted. So you don't need to pay income tax. Usually, if you, let's say, invest in equity, you would have to pay 20% in 15% in long-term capital gains. So that kind of tax is not there in these plans.
These kind of schemes or these kind of plans, do they give you inflation beating returns? Because that's the whole purpose of having an investment strategy.
Yeah, so you can say that they barely manage to beat inflation, because in India the inflation rate is usually in the range of 5%. So that kind of returns you can expect.
And how do we pay the premium? There are single premium policies also. I mean, how is the premium structure panned out? I mean, I'm sure there are a variety of policies offering different kind of premium payment options, but then what all is famous, and what all is actually right? What way is right?
So it depends on what kind of investments you want to make. Some people have a lump sum amount of money they want to invest at one go, so that is available, which is called a single premium plan. The other type of plan is a regular premium wherein you pay for the entire policy term. And the third type is you pay for a limited term. Let's say your policy is of 20 years, but you pay for only 5 years. So these plans have that kind of flexibility to offer you variety of premium payment options.
Talking about the charges, could you just explain us what kind of charges are we talking about? The mortality charges, policy administration charges, because I think this all cuts when you pay the premium the first time or for a couple of years.
See, if you talk about ULIPs also, there will be charges. So the most of the charges are obviously, one is the mortality charges, which is to cover the insurance part. And then there is administration charge. And then, for traditional plans, the charges are much higher because uh, they pay a lot of commission to the insurance agent. So that commission upfront, which is paid, is usually charged as allocation charge in the first few years. But in ULIP, that is not the case. The allocation charge is very, very minimal. But apart from that, the administration charge is a very small amount. It is usually in the range of 1.1, 0.2%. So that is not a very big number that can move the needle. The insurance charge is also again justified charge because that is the amount that provides you the insurance coverage. But the most important one that doesn't favor the traditional plan is the initial charges that are charged because the brokerage is paid.
For how many years we really need to continue paying the premium so that the surrender value later on, if we decide to discontinue or maybe the policy if it gets lapsed, the surrender value is tax free.
See, minimum is 5 years. So if you really withdraw before 5 years, you will find out that you barely get anything because initially, as I told you, there are a lot of charges that are incurred by the insurance companies selling these plans. But after 5 years, usually you manage to get a decent amount. But still, in a lot of cases, the amount is not more than what the person paid. So if you really want to go for traditional plans, our suggestion is that you should forget that money. Only when you have that time horizon of 10, 15, 20 years, that is when you should go for a traditional plan.
Reports over here, Naval, say that regular premium payment for 2 years is needed to get a surrender value tax free.
Yeah, tax free is a separate matter. What I
Yeah,
meant to say is that
that's what I wanted to know. Yeah.
usually if you withdraw such plans in 2 years, you'll end up getting 50 to 60% of the premium that you paid. So that is the kind of loss a person would incur. So tax wouldn't even matter because you are already at loss.
So once we decide to step into this policy, and what if a person doesn't want to continue it? What should be the strategy to come out of this kind of an investment? Because this is definitely not, it's giving you stable return, but then it's not, it doesn't have like a high potential of giving you return that the other investment options have, clearly. So what
Right.
should be the strategy to come out of these guaranteed schemes?
See, usually, if you want to really get out, that is a very bad situation to be in. But still, if there is a situation, then making these policies paid up is the way to go. Because what happens in such a case is that basically, let's say you pay for a premium for 2 years, and then your policy, let's say, requires you to pay premium for 10 years. And has a certain sum assured. So what you can do is tell insurance company that I don't have any more premium. So make this insurance policy paid up so that at least the sum assured is decreased, but your policy runs for that period of time. So you don't incur a lot of charges, but still the charges are big enough for somebody who is really looking for higher returns. So that is a avoidable situation to be in.
Right. So, in a nutshell, guaranteed return plans, as the name goes, it gives you a benefit of insurance and investment. But then, definitely, when you are designing your financial portfolio, it's always recommended that one has a separate insurance portfolio and a separate investment portfolio. If you club in these kind of features in one particular product, you might not be covered very well on your insurance part, and you might not be able to even generate returns that would beat inflation. Thank you so much, Naval, for being on the show and explaining these kind of policies to our viewers. With that, we take a